So I'm joining you from Frankfurt. Like Thomas said, we're a German equity manager, but we manage global portfolio in a systematic way. Who some I saw in the audience, some people know us from prior presentations. So my topic today, Thomas already gave a quick overview, is a question in terms of the U.S. equities outlook. Do we have growth risks? Thanks to Rahul's and Nick's presentations, we've already heard a lot about the macro outlook and the risks that were highlighted already in the comparative way between Asian, European, and US stocks, and how large partially that growth concentration is one of my key concerns for the US market. So my question is for 2022, whether it's actually time to allocate even more to US value stocks. For the ones of you who haven't heard of Source for Alpha yet, we're an independent asset and wealth management firm based out of Frankfurt. In terms of the picture you see behind me, I'm actually virtually sitting outside our offices here in the West End. In reality, I'm sitting inside. We're founded 11 years ago. I've been running this US equity fund. I'll be presenting since inception and founding of the company 11 years ago. Actually, 12 years, the company age now 2010. We're already in 2022. The fund's 11 years old, launched in May 2011. We managed about 600 million assets under management, of which 100 are in this US equity fund. And our philosophy, as you may have already guessed a little bit from the name, Source for Alpha, it is about looking for added value in capital markets, and we use this basing our investment strategy on systematic investment strategies and using academic research findings. That's what's our USP, our differentiator. We're different in that we manage global portfolios all out of here, Frankfurt, a team of 20 people, highly specialized on systematic rule-based investment strategies. What do we do? First of all, in the first step, we spend a lot of time in research, so academic research, providing us insights into the functioning of capital markets, transferring that into systematic, academically founded, let's call it, investment strategies. And our added value is that we have this systematic approach where we can explain exactly what we've been doing over the last 11 years, what we will do in the future as well. So I'll be talking a little bit about that in detail. Now, so much for Source for Alpha and our philosophy, and now to the big picture, that risk that I see and that we see, and that thankfully Nick and Rahul have already mentioned a lot, is we have 10 years of growth rally. We have in the US especially, not so much in the other markets, but in the US, we have some huge names. Here, I've graphically represented that. I know a lot of you are joining us from Germany, representing the DAX 40 names, 1,885 billion US dollars. So that's about roughly rounding it up, $2 trillion market cap, those 40 titles, with the largest one, SAP, at 150 billion. And then on the left-hand side, you'd see the US top 7, all big tech growth firms. Apple, this is as of year end at almost 3 trillion. In the meantime, having breached that groundbreaking threshold, only going back 16, 18 months, they breached 2 trillion. Now they're at 3 trillion market cap. We have Microsoft at 2.5 trillion, Alphabet almost at the 2 trillion mark, Amazon not far behind. And then you have former Facebook, now Meta platforms, Tesla. We already heard Tesla mentioned in Rahul's presentation, and Nvidia. So you have those big top 7, the biggest 7 stocks in the S&P 500 at an incredible sum of almost $12 trillion market cap. So dwarfing any individual stocks and even the whole German market, with both Apple and Microsoft and Alphabet being worth more than the entire DAX combined. And this is unprecedented in history. We have never had a time when one sector, that growth sector, technology-based, software-based, has so much dominated global markets and especially the US markets. And concentration in individual names has been so high. So this is one of my key concerns. If I look back into history, and this is one thing that we always do at Source for Alpha, we look at what can history teach us in terms of the empirical asset pricing research, but also just basically, let's call it a capital markets historian approach in order to glean insights for the future. I've looked back here on the last 22 years. If you look at this chart, I'm starting in year 2000 with the top 5 in the index being Microsoft, GE, Cisco, Walmart, and Exxon. Microsoft with about a 5% weight. So this was the top of the US tech market of the 90s before it's coming down. This is end of 99, beginning of Jan 20. We have this huge weight of Microsoft, but the rest, and obviously Cisco, another one of those tech names, but GE, Walmart, Exxon are different industries and are, let's say, the old world also in that. The total top 5 back then were 16.8%. Forward 5 years after the bubble burst, the tech bubble of the 90s, the top weight of the top 5 is 13.3% in Jan 2005 with GE at the top, Exxon. Microsoft has halved in terms of its weight of the index. And then we're at Citigroup and Walmart. So now we have a financial services firm in there. Walmart still represented. Another 5 years on, Exxon is now number 1. Microsoft still same weight. Walmart, Apple, we see back in the top 5, and Johnson & Johnson. Another 5 years later, you see the share. If you look at the share of the total share of the top 5 is now only 10.6% in January 2015. Now Apple is already spot number 1. We still have Exxon, Microsoft in terms of its portion of the index, not that large yet. J&J, Wells Fargo, so financial services back after the financial crisis of 2008, 2009 with some representation in the top 5. Always a diversified portfolio. And now basically this huge growth rally starts. It's 10 years, so let's say rather the last 5-6 years that we're looking at. In the top 5 in January 2020, before we went into Corona, are already Apple, Microsoft, Amazon, Alphabet, and Meta, back then still called Facebook. Now we already see an increasing top 5 weight of 17.1%. This is of the whole S&P 500 of those 5 stocks. Apple already 5% weight. And now if we look at December 2021, beginning of this year, we're at the 23.7 weight of those big 5 names. So we have Apple at almost 7% of the index, Microsoft 6%, Alphabet 4.3, Amazon 4.0, and Tesla 2.5. If you now add Meta and Nvidia, you're reaching more than 25% total weight. It's 27% of the S&P 500 in those big 7 growth tech names. This is a historically unique concentration on a few individual securities. Obviously, I'm not doubting the quality of those companies, highly profitable companies among them. But the question is, can all of them as a whole justify such a huge concentration, such a huge share? Or is there some air to be let out? Is there some potential for other sectors, other names to catch up? Plus, the second thing that is a consequence, just passively, if you've just invested in an S&P 500 index, you have this exposure that has basically grown due to this rally. So a lot of investor portfolios have a high concentration in these areas. And that's my key concern. And that is actually a concern of a lot of our investors who believe that we need some diversification and therefore are interested in investing with us, because what we provide is a systematic, rules-based investment approach that has a value investment strategy that can provide excellent diversification to a portfolio, either if you have the S&P 500 ETF because you have this 27% weighting, or provide diversification to active funds that have high positions in those growth names. I'll start this a little bit around backwards. I'll show you my top 50. These are our top 50 in our index, our S4A US Long Equity Fund, a value equity fund. I have them here in alphabetical order. So just so that I have an idea, you find and you don't see any of the top 7. It's a value fund. We do have and do hold some of the mega caps, some of the better known, bigger ones. So number 8 in the index, for example, is Berkshire. As you see here, Johnson & Johnson is one of those top companies, or Procter & Gamble. But we generally hold a broadly diversified portfolio of about 70 positions in all kinds of industries, but with a clear value focus. If you just look through the portfolio, we do have all industries. I will look later into a bit of the weightings into each industries. We have financial services, we have insurance companies such as Allstate at this in this industry, or Globe Life. We, and Berkshire I already mentioned, we have industrials, 3M, Johnson Controls, or Snap-on. I'm just naming a couple of examples. Or in terms of consumer discretionary, auto parts is one example, or Garmin. So it's a very well diversified portfolio that does not have any exposure to the highly valued tech sector, therefore provides a good diversification. Plus, and now the key question is how is the performance, and how do we actually manage the portfolio and get to this portfolio? We're very proud of presenting a now 10.5 year, almost 11 years since inception track record that is on par with the S&P 500, despite not investing in the big growth firms and growth names. So our fund is actually the best performing value fund for US equities, systematically managed here out of Frankfurt and beating any of the big US names. We do have difficult times against the index when value has issues, let's call it. It's a factor-based investment strategy that has a clear exposure to the investment factor. Now in 2014, 2015, as you see as in this comparison to the S&P 500, or 17, 18, we underperformed to the index. But in the times that value does well, 12, 13, or 16, we have an outperformance. And especially interesting is the last three and a half years. We've been outperforming 19, 20, 21, and also since the start of the year. And this despite the last three and a half years being a market driven by the growth names. And that's due to our investment approach, which I'd like to highlight a little bit in the following. But this was a comparison with a global, with the S&P 500 index. Now here we have comparison with a value peer group. Over the last 10 years, last 5 years, or 3 years, we are the best performing fund in the Morningstar Equity US Large Value Peer Group. In September 2021, so about 3 months ago, Morningstar reclassified the fund into the Equity US FlexCap Equity Peer Group, which we're in discussion with Morningstar about because it actually doesn't reflect the investment strategy. We are a clear value fund. We only have value names. You see the benchmark of the category here, the Russell 1000 value. We almost exclusively hold stocks from the Russell 1000 value, with a concentration of the large cap stocks that are actually part of the S&P 500. So a highly liquid universe with a value approach that has clearly outperformed compared to the equity US value category at Morningstar. You just look at the 10-year returns here, 3% outperformance to the category average, and 1% annualized outperformance to the Russell 1000 value, being the top performing fund. So we have a top decile fund in this peer group. If you compare it to that FlexCap equity peer group, if you call up your Morningstar screen in parallel, we're still in the top quartile. So among the top 25%. So obviously in the FlexCap equity peer group, there are some companies, some firms that also have some growth exposure. And that's basically what we never have. In order for you to see how do we generate our performance that I've shown you, I've brought to you a performance attribution. We're obviously willing to share and discuss this slide much more in detail. I'm just going to highlight a little bit. This is an internal performance attribution using our holdings, and we've compared the 10 sectors in the S&P 500. On the left-hand side, the GICS codes from energy, materials, industrials to utilities and real estate. You see the average weight that we have in our fund in the last 5 years. This is leading. The data is onto, it's actually almost 6 years. Normally we do this on a 5-year rolling period. This is until November 30, 21. We have an average weight. So let's pick out a sector where we are clearly highly weighted, such as industrials, average 23.53%, with a return of the stocks that we hold the names in this sector of 209% on average over those 5 years. In the S&P 500, the average weight of industrial sector is 9.33%. So we have a clear overweight. And the average return of all the stocks in this sector is 105%. So the stock selection in this sector worked. And then you see the performance attribution on the right-hand side. In terms of allocation and selection effect, you see that from the fund outperformance over those 5 years, total outperformance of 12%, it is mainly driven by selection, and selection working in all sectors, systematically working best in the industrial sector. The second most interesting sector is obviously information technology. This is where the big growth weight in the US is, the one I'm so concerned about, highlighted on the slide earlier. You see, we have a clear underweight in information technology, which is a result of our investment process where we select value names based on their valuation, based on valuation factors that are quantitatively derived. Now we have an IT average weight 9%. We have an average weight in the S&P 500 of 24%. And you see that this is the sector where our selection actually does not work. And then you also see that in terms of our total performance, that's the drag that historically has been the drag on the performance of the fund, is the allocation decision to underweight the IT sector. So the last 5 years, we've managed to outperform the S&P 500 by performing well in terms of stock selection and performing basically on all sectors except the IT sector. And that is a factor of this huge driver and growth rally of the last 5 years. And I expect with our investment approach, we will be quite well positioned for normalization in terms of that. So if I go back to what Rahul and Nick presented about the opportunities you see in Asia or in Europe compared to the US, I actually would venture that you also see some of those opportunities inside the US in terms of just not investing in the highly valued tech and growth areas. It doesn't even have to be just not investing in the top 7. Obviously, among the top 7, there are highly profitable companies, with Apple soon reaching $100 billion profit. But I'm more concerned about some other pockets of the market that are actually non-profitable tech growth, highly valued, that will be quite impacted by rising rates in the future. We've heard a little bit about that from my predecessors in terms of their presentation, that in the US we'll have QE being reduced. So this purchases of bonds are going to be over in a couple of months. We'll have probably 4 interest rate hikes, maybe reaching 1% interest rate already. This should be all a drag on those highly valued growth stocks, and should favor defensive value stocks, such as the names that we hold in our fund that I have presented. And last but not least, because I want to have some time for questions and discuss with you and not keep you too much over the allocated time. Here I'm showing you the assets under management growth of the fund over the last 5 years. We are very proud to have reached $100 million in the fund, having grown over the last 12 months from 40 to 100 million. We'll receive another allocation of 10 million next Monday. You see below the net flow of funds, you see it's especially concentrated in the last 12 months with 4 or 5 bigger allocations that we've received from fund manager, from managers from quite well-known names. So we see an interest in our top position fund, and I'm happy to discuss with any of you who's interested. Just drop us an email or give us a call if you're interested in hearing how we actually manage US equities. You see my contact details here, plus my colleague Cesar, who's our fund sales and relationship manager. We're happy to discuss.